Yeah.
I'm just gonna do a quick intro. Good afternoon, everyone. Thanks for showing up today. This is awesome. It's my privilege to introduce David Arbit today with the Minneapolis Association of Realtors. He's a genius at data mining and giving us palatable and valuable information to help us guide our sellers and buyers through this crazy market. So, thanks.
I'll take it. Thank you. Thank you. So for the Zoom, so how are these guys going to see?
If you share your screen, it'll show up on here.
Let's share. There you have it, folks. We're going to share things to share things.
Please share.
All right. It's no fun when you keep all the data for yourself. Okay. Oh, 3. Let's get our share. Okay. There's only one screen to share. I think it's this one. Looking good? More or less? Yes, all right. Looking promising. Very promising. Okay. So, yeah, let's talk about the market, you guys. We're going to talk about the market. That's not a surprise to any of you. It's been a fairly crazy market. That also shouldn't be a surprise to most of you, hopefully. So we're going to talk sales, listings, prices, market times, ratio of sold to list price, absorption rates. We're going to talk about a lot of fun, cool stuff. Sound okay?
Yeah.
Time permitting at the end, I'd like to do a little bit of an interactive, like just a quick 5 to 10 minute interactive session using info cards. You guys are all pretty familiar. Okay, good, good, good. I'm going to throw a lot of fish at you guys. Just know that you're going to get hit with a lot of fish, but I want to teach you guys to fish a little bit before I kind of turn you loose. Okay. You know, when we talk about data, I like to open with a note of levity or an interesting note, kind of gets our thinking caps on. So our fresh water, you guys thought about the fact that it's so old that every time you drink a glass of water, you're most definitely swallowing something that passed through the body of a dinosaur? You don't wake up and think, yeah, you don't think about that. I drink things that pass through the body of a dinosaur. I don't know, kind of gets you thinking. Anyway, enough with the jokes.
Was that a joke?
But that was.
It's a possibility. It's a possibility that had an element of humor. It's a possibility. Zach Galifianakis, it's a funny guy. Okay. Daily showing activity, and let me double check something here, guys. So we're going to run through showings. Why do showings matter? Right? It's the thing before the thing, isn't it? Right? So we care about showings because they tell us things before the rest of the market can show us things. Let me grab something real quick here. Share something. So, you know, with some of the showing stuff, we're able to see sort of what's happening. Just like I said, we're able to get a little bit of a leading indicator into what's happening. So let me get back to full screen here. And I want to show you guys. So through, you know, just a few days ago, you guys can see how, and okay, good, that doesn't show up there. You guys can kind of see how showings have looked for the last, 4 years. So here, 22, our darkest color here, look at our 2021 trend line up here, and then you can really see the COVID signature in our 2020 trend line down here, right? You can't make this stuff up, just like clockwork, right? Shutdown order, March 16th, we saw showings kind of crater, but came back pretty quickly, didn't they? Really quickly. And so one of the things that's interesting is look at maybe some of the losses here, but we made up most of those and then some back here, didn't we? So it was kind of like, you know, spring market became summer and fall market. And so some of that strength obviously carried through into last year, into 2021. So look at first half of last year, right, looking pretty strong. And then the second half of the year was still strong, but it looked like it was down, but that was only relative to the year prior. Does that make sense? So look at 2021 here, where, you know, we're kind of above, well, pretty much all the prior years. So we were showing a lot of plus signs, but then we were showing a lot of minus signs. And it wasn't that 2021 was weak, it was that was when 2020 climbed above. So what happens in the baseline period kind of matters too. I know you guys know that, but just a reminder on that. Okay. So looking at activity by price point, of course, the market is not monolithic, right? Not all price points behave the same. So it's important to break things down. We have a got a thought. It shows up differently down here. Can you share slides? Yes, absolutely. We will absolutely share slides. Yes. So share of overall showing activity broken down by price point, and that's for the most recent week this year compared to same week year prior. So for a while we were doing a 2-year change just because it didn't make much sense to compare to a wonky market. Is it a normal market? Is there any normal anymore? I don't know what normal is. I just know I'm not it. So share of overall showing activity, just kind of looking, you guys, you can see declines in the most affordable ranges, right? Declines in showing activity in the most affordable ranges. And then we start to see some gains as we get into our luxury segments. So it looks like the cutoff point is 300K, where we see growth in the share of showing activity from last year to this year, right? Everything else under 300K lost showing activity, right? The showing activity in these 3 segments made up a smaller slice of the pie than they did the year prior. No surprise, there's not the inventory there to show. No shocker, right? We know why. We don't have to dig too deep. But this kind of helps us visualize things a little bit. So bulk of activity, right, still in that 250 to 3 range, which may come as a surprise considering how little we see under 3.25 and 3.5. So interesting data point there. And then we see some increases as we, of course, climb the price ladder. So don't discount million plus from 1.5 to 2.1, right? That's a significant increase. So luxury rocking and rolling here. Let's keep trucking. So change in showing activity, just sort of another way to look at this year over year data here. You see weakness in our affordable ranges where we just don't have the product to show. So you can't go show it because it's not there to see. And then we see, this is where we see our gains as we get into 5 to 6, 6 to 8. Looks like we took a little breather from 8 to 1 million. And then as we get to a mil plus again, we show an increase in showings. Okay, this one is fascinating. I like this one. It again, when in doubt, zoom out. So let's just kind of keep this high level view in our minds. I should have made that text a little bigger, guys, forgive me. Just know that the lightest color here is the oldest year, right? 2018 all the way through 2022 here. So this is new listings. So don't get all doomy and gloomy on me, right? No, listings aren't growing, but we haven't had that much data for this year. So it looks kind of artificially low. What I want us to take away is 2018 and 19, right? Kind of up here, I guess, somewhat normal years, if we can still use that word at all, ever. And then look at 2020, look at how much 2020 flattened. Usually when the market peaks in May and June, we see 2020 really flatten and skew toward the back half of the year, right? You can see it, it's this blue. You can really see it, look at it flatten out and really bend toward the back half of the year. So, you know, here again, you guys, when we're looking at this year over year change and we're saying, oh, well, sales are up from 2020 into 21, right? But then they're down. It's not that 21 changed as much as 2020 changed, right? And we can kind of see that in the data. So that's new listings. How about signed contracts? Oops, how about I blow by it too fast so no one can see anything? So pending sales, so very similar situation. You guys can see 2020 skewing. Looks like sales demand peaked in 2020 in August. Demand never peaks in August. That's not what happens in our market, right? Unless we're in a pandemic, of course. You guys can see, right? When do sales usually peak? End of May, early June. That's when we usually see that seasonal high, right? That sort of peak seasonal curve there. So yeah, just so we kind of have our thinking hats on about what has happened in the last couple of years and how it's going to impact some of the data that we're looking at today. Okay, so 2-year change. I do want to do a 2-year change. So this is new listings, seller activity, not year over year, but Feb of 22. You guys see at the top versus Feb of 20. Big winner here. Big bucks. It's the big buck stuff. Yeah, million plus. Listings. So are sellers just dumping product on the market? And are they wrong? Is there going to be a glut and oversupply where they have to drop prices to clear out that excess, right? That's what happens at the clearance racks at Macy's. It's not different, right? I have an excess product, I lower the price, shove it on the clearance rack, and we'll clear the market. So are we going to get all this excess, right? Well, no, because look at pending sales, right? They're up significantly in that million plus segment. And this is 2-year change, so this doesn't quite do it justice, but we're going to look at luxury in a couple different ways today. So no, all those sellers are not crazy. I do think it's interesting, again, if I own something at 180K, you can't pry it from my cold dead fingers, right? I'm liking the payments on it. I don't know where I'd go, and I don't know what would happen to my price, and I'd get smaller. I'd probably get fewer feet and further out, and that doesn't seem to be a win for me. So pending sales, similar story, guys. If the product isn't there, I can't write an offer on it, sadly, and you can't show it, sadly. So we see inventory evaporating in these lower price rungs, in these entry-level, first-time buyer segments, affordable segments, whatever phrasing you like. It's not there. It's just not there. So change in new listings. So similar story, guys. This one's year over year. So this is not, so last was Feb of 22 versus Feb of 20. Now we're looking at all of 21 versus all of 2020. So this one, more data, just more reliable trends because more data. February could have been a wonky month. Was it cold? Did rates do something funny? Which they did. So, you know, any one month can just be a little bit wonky. So it's useful to think about it this way. Okay, so the data is beautiful, you guys. It's a sine curve. Look at this. The data is beautiful. I mean, it doesn't, I wish it were telling a little bit of a better story under 300K, but it's a beautiful story, even if it's not the story that we want to hear. So look, new listings down in our most affordable ranges. I feel like a broken record, but there we go. Looks like our biggest gainer here for sellers was $500,000 up to 3/4. Kind of interesting. And then 3/4 of a mil up to $1 million, and then $1 million plus with a 13% increase. So February, as we saw, can be kind of wonky versus the year as a whole, right? It's nice to look at the year as a whole. So as I said, look at closed sales, you guys. Look at million plus closed sales up 50%. 50%, right? I mean, I hope you guys have felt that a little bit. I hope you guys have found some opportunity, you know, as we climb the price ladder here. There is more to go around. So 50%, guys, the COVID shuffle. I want more space. I want entertainment space. I need outdoor space. I need a second home classroom for kids, a second home office for adults, right? I have needs. And if I'm a high net worth individual, I don't even have to sell my old home to get that new space, right? I've got that flexibility. I've got that wherewithal. We really see that showing up in the data. We really do. So I'm going to co-plot these. Co-plotting, don't overthink, just means plotting them on the same chart, same graph. So I'm looking at 2-year change in new listings in gray and 2-year change in signed contracts in blue. So change in supply in gray, change in demand in blue. Again, don't overthink. I mean, what do we notice about every price point over what, 350? I'll make an observation. I see blue is bigger than gray. How's that? Blue bigger than gray. We don't have to overthink. What does that tell us? That demand is growing faster than supply. Wow. I didn't need to come in to tell you that, right? But I mean, it obviously varies a lot by price point and by area and by market segment, right? Condo, single family, new, existing, 10,000 square feet, 1,600 square feet, right? So yeah, it's pretty clear. There's a lot of blue here and not a ton of gray, which really paints the picture and just highlights how much demand has risen relative to supply, which has barely risen at all and even fallen in some price points. So supply down, so seller activity down 2% between 750 and $1 million, while signed contracts up 48%, right? That's a difference. There's a delta there. That matters. Okay. And then I just did 1-year change, so 22 versus 21. A little bit of a different picture, but again, we're comparing against a pretty wonky month, a pretty uniquely strong period. So is that really apples to apples? I think most would say no, but here's how it looks just in case. All right, we're gonna shift gears to long-term trends. When it comes to data analysis, my friends, you excel. All right, more like it. So, all right, housing market activity, guys. Let's take a historical view. How many of us woke up today thinking we would see data back to 1967? Life, my friends, is filled with surprises, right? Most of them good, but not always. So, okay, so housing market activity. So in blue, you guys will see new listings, right? Simple enough. Seller lists something, it is a new listing, and then closed sales in red. So we see our demand indicator in red. Two big things that stick out to me, like Mount Everest. And they are the Mount Everests. I hope your eyeballs went there as well. So historically, guys, what's characteristic of a bubble? Bubbles are typically supply driven, aren't they? There's a lot of supply relative to demand. Builders built a bunch of condos, bunch of single family subdivisions, right? All that supply, look at this run up in supply, the demand, right? The buyers came along for the ride at the beginning, but then Lehman collapsed on them, and then their adjustable rate mortgages ballooned on them, and then they lost their jobs, and so they didn't qualify for a loan, or they lost their jobs, and then they did qualify for a loan. Never mind. There was a time you can fog a mirror, you can get a mortgage. So those are the two first observations, and guys, those both ended in recession, right? 91 and 08. Those both ended in recession. Interestingly, the 01 bubble didn't, or well, the 01.com bubble didn't really have a housing bubble element. And we can see it wasn't really, we didn't have a supply driven market back then. But man, oh man, look at 07 and 08. That is a supply driven market. Again, buyers in red looked like they were coming along for the ride until the world changed on them. And then all that supply had to be clearanced out on the clearance rack with the price dropped, right? Some of it went REO and short. And so investors or flippers descended and scooped it up for 50, 60, 70 cents on the dollar. Okay, let's keep trucking. So three other things I want to mention in addition to supply-driven markets. Look at how tight the market is now. Look at how tight supply and demand are with each other. I really only see maybe this other time and maybe this other time when things could have been that tight. But let's look. Let's take the ratio. So instead of looking at new listings in blue, is that right? New listings in blue and closed sales in red, let's take a look at the ratio of sales to new listings, right? So what this tells us is for every 100 new listings, there were 88 closed sales, 88 to 100, right? 88 sales for every 100 new listings. The vast majority of what sellers are listing are getting bought up and flowing off market, right? You guys experience that every single day. So sure enough, going back to 1967, this is the tightest ratio we've ever had between supply and demand for any year going back to 1967. You guys can see in that 99, 81, and then even in the late 70s, 63. And you guys remember heading into the early 80s, maybe some of us remember heading into the early 80s with 15% interest rates. Now we're seeing 4.2. Oh my God, how will we afford to eat? 8% is the average, 4% is half the average. Interest rates are still remarkably attractive, but they're no longer sub 3. Yes, we're going to have to live with that. You got a thought?
So Tim Saprell from our office was
I know
talking
Tim
about
well. Yeah.
population, the growth in buyer population, right? So they're more millennials.
Generational stuff. Yeah.
Do you look at that too? Are we going to talk about that?
We do look at some of that demographic stuff. I don't think I have any slides prepared for that today. Happy to follow up separately. Give me a card. But yes, as you see millennials aging into this prime home ownership age, they're being met with a historically low supply
And
of
I
housing.
think when you see that, the supply and that last slide,
Yeah.
them being so close together, I think that must be a factor.
For sure. For sure it is, yeah. There's no doubt about it. Yeah, with the first timers coming in or trying to come in, getting frustrated, and I don't think it'll pay to wait, but sometimes you have to. So yeah, good thoughts there. And just know, you guys, this ratio is up and down, but it has never been this tight for any year going back to 1967. Never has buyer and seller activity been so close, right? It's never been this close. All right. So let's dive into some of our metrics here: new listings, pendings, closings, market times, prices, inventory. So we're going to talk about it. So first, let's start with December of last year. So I haven't brought us up to 2022 yet, but I will. So what do we see? You know what, guys? How do I kind of want my laser? I don't have my laser. Just want my laser. To annotate. Spotlight.
Apps at the bottom.
Hey, I like that. Not bad. Lucked out. Okay. And can I close this? All right. Looking good. Nope. Looking bad. What happened to my guy? All right, we'll have to live with the mouse. Okay. So you guys can see, right, new listings in 08, last kind of high water mark at almost 5,000. You guys can also see, take a peek at December 2020. There we had that 24% jump in new listings. Did it look like we were going to kind of head, the sky's the limit, folks. We're going to have more supply to sell. Yippee. False. Fake news. False, right? False. So some of that was pent up supply, right? Lots of different reasons for that, but we did not see that continue into December of 21. So again, I guess I'm somewhat encouraged by the fact that 2548 is slightly higher than 2525. But yeah, we're down 18%, but then again, we were up 24%. So I guess, yes, technically we're down 18%, but this was an unsustainable, unique month. And so I just think that's worth mentioning to your buyers and sellers. Why does it not like me? Okay. So, oops, now it likes me too much. Okay, so Feb new listings, guys, just looking at amount of product that sellers bring on during the month. So down about 6.5%, and you guys will see here again. I guess I'm grasping for straws here, but I guess I'm slightly encouraged by the fact that we are above Feb of 2019 levels, but we're the second lowest February of any year going back to 03. I wish I had better news to share with you guys. I really do. I don't, but I wish I did. So, given where demand is at, well, that's pendings, but if we look at closings, right, given where demand is at, easily back to these levels, we need supply to cooperate a little bit, and it's not, right? And it's not.
Go back to the pendings.
Yep.
Because I feel like in years past, demand hasn't started peaking in February the way it feels
That's true.
like it is now, and
You're
it's
saying
probably
different now.
yeah. I feel like it's a little bit spurred by all sorts of things,
Yeah.
but new listings is one thing, and then of course the demand for those listings can change based on a lot of exterior factors that we don't really have a whole lot of control over.
Absolutely right. Yeah, 100% right. No, you make a lot of really good points. So, yeah, more good points on top of yours. Let's see. You make good points. So Feb is, you guys taught me this, I think. Super Bowl, right? Market kicks off after Super Bowl kickoff. I always like that. Spring market, but that's going to show up in new listings before signed contracts. The thing about the pendings, the under contract number, it's this, right? They're all Feb. So it's not like we're doing a Feb to a June, but I think it is worth noting that, while down 10%, you guys, I'm not sure we broke the trend because we've had some ups and downs on this trend, and yet we've seen demand grow. And yet we've had some minus signs here. So I sort of feel like people are getting a little down on themselves when, some of this stuff was expected. It's just hard to meet that high watermark without the supply. We have even less supply, even fewer active listings than we did. So 2005, always an exciting one for me, up 100%. Can anyone say bubble? Yes. Yes, we can. Good thoughts. We're going to come back to some of those because I think you had some other good ones in there. All right, so February closed. So yeah, we did have to come down 14% from our high water mark of almost 3,300, which was easily the highest level for any Feb of any year going back to 03. Kind of in the crash, coming back a little bit. So, here again, you guys, I don't know if our trend is broken. Also remember, closed sales are a lagging indicator. Pendings are the now. Signed contracts happen now, right? Closings happen, 30, 45, 60 days after that contract was written. Well, the contract's written with current market conditions today, right? The closed sale can lag those conditions, can lag. The market could change a little bit in that month or two between signed contract, accepted offer, and closing table. Speaking of the amount of time that elapses between the new listing and an accepted offer, where do we stand? We stand at 17 days for February. Guys, that's actually a long time. You think I'm crazy? That's a long time. Let's see. Well, no, I'm jumping way too far ahead. That's a long time. We had 7 days last year. There was a couple months with 7 days where the median, guys, median was a week. Meaning, what's our median tell us? Half took longer, half took fewer than 7 days, under 7 days. Half of our signed contracts went under contract within 7 days. We know some went under contract within 4 hours. We know some other listings took 100, 150, some 200 days, right? They're out there. Probably a million plus. There's probably not that much between 2 and 4. It's going to take much more than 100 days. But 17 days, you guys, we've scrubbed off 104 from 2011, right? Even more compared to 08. So things are moving quickly. Homes are selling quickly. Median sales price, let's make dollars of the cents or cents of the dollars or whatever it is we're going to do. So prices up 8 1/3% from Feb of 21. And that was after an 11.5% increase in 21 compared to 20, which is totally fine because everybody's income is rising at 11.5% every year, right? Totally fine. There's nothing to see here.
What's the delta?
Everything's fine.
20 and 22.
20 to 22. Ooh, so 280 plus 60. What's 60 out of 280? 20, a little over 20%. Yeah, substantial. I'll climb out on the skinny branches and say that's significant, right? Or way out on the ice, as we're supposed to take the ice shacks and ice castles off the ice. What's that?
The ice castle.
The ice castles off the lake. What's that? What's the lake outside Brainerd where the truck always falls in? You guys know that one? There's a thing. There's bets. They place bets.
Right.
Is that Brainerd? Is that Mille Lacs? That's Mille Lacs. And they place bets when this old pickup will fall into the lake. Some really cold year. I think it was like April or something. Yeah, June. Was it June? It was early June. I was going to say June. No, I think it was early June. Yeah, it was May. I think it was early June. Yeah, a lot of ice holding up that truck. Anyway, so you can kind of see what's been happening, in terms of overall price movement. Guys, million plus has been rocking and rolling. We haven't seen a ton of opportunity sub 200. So just know there's factors here that are impacting this. Another quick thought, excuse me. Another thought on this. Yes, home prices are rising. That is undeniable. But is every home worth 8.3% more than last year? No, some are going to be 15% more, and some may actually be worth less, right? A condo and some, whatever. I mean, so people look at this and they're like, oh, well, everyone's home is worth 8 1/3% more now. It doesn't quite work that way. And remember, it's not all supply and demand. What about product? We had shift in product to million plus. Well, that's at a higher price point. That doesn't always speak to the supply and demand between 3 and 400K. Does that make sense? Yeah. So that activity on the luxury end yanks, it pulls, right? It has gravity. It wants to pull that toward, it wants to pull our median toward it. So just a couple other things to think about. A couple other tools in the toolbox. That's really what it is about, guys. Tools in your toolbox as you're thinking about the market, as you're at opens and listing presentations and just talking with buyers and sellers. Having the tools you feel that you need to be successful. What happened last May? Prices rose 16.5%, which is also totally fine because income growth is about 17%. Right? People are lucky to get half of inflation. Half of inflation, 3% nowadays, by the way. So that's a good day. So 16%, guys, what I see is deceleration. I don't see a decline, but I do see a deceleration. So we're going from Mach 3 to Mach 1. We're going from 75 on the highway to 68. We're still going pretty fast, but not quite as fast as we were. So, right, you guys can see 16.5% down to 15, down to 12, 11, 10, 8. I guess we flirted with 10 again, 8. I guess we flirted with 10 again. But you guys kind of get the idea. I believe the 15 and 16% days are hopefully behind us, right? Hopefully behind us. Just kind of looking at that, this is not price level, but year-over-year price change, right? I like this one. I have an affinity for all of these charts. But I like this one because it speaks to the rate of change, not just the price level, but the rate of change, right? So 08, 09, right? No surprise, prices were more or less in free fall, right? We had 1 month where we lost 25% of our price. We went from 200 grand to 150. 25% evaporated. 50 grand evaporated overnight. And then we've really had some months where we've clawed our way all the way back and then some. Who remembers the tax credit? Who was in the business? Was that 12, 13 years ago now? God, doesn't seem like that long ago. My God, yeah. 09, there was that first one in 09, and then it was pushed to 2010, and it was April, then I think it was September. And then you could layer that with the Minneapolis Advantage money, which was $20,000 forgivable over 5 years if you homesteaded. So there was some incentives in the market around this time. And so look at what prices kind of did as a result. But then they had to find their value. They had to find the floor, find their footing. And they did. And then, man, oh man, did the investors and flippers descend and really pay top dollar and outbid one another to convert to rentals, right? Appreciating asset plus a cash cow. Hard to beat that, right? Really hard to beat that. And then we see price growth sort of stabilize, right? Get in line with historic growth trends, and then enter COVID, right? Early 2020, and you can't make this stuff up, you guys. Look at the blue bars after COVID are higher, right? Kind of feeling a little bit like what we were as soon as we got out of recession, that fast growth, right? We were kind of slingshotting out of recession a little bit. Not all in terms of GDP and unemployment, but at least in terms of home prices for sure. Again, I'm noticing a little bit of normalization here. Again, we're down from that 16%, but I just want us to see that's kind of how it looked. All these price gains post-COVID, AC in the AC era, after COVID, DC before COVID era. I understand those have other biblical interpretations. But I use BC before COVID and after COVID. All right, let's have some fun with it. Why not, guys? Percentage of original list price received at the time of sale. I'm a seller. You're listing my home for $350K. I want to know what am I going to get? What am I really going to get? 360, 340, 400, right? What am I really going to get? Well, 100.7% is that average, right? Is that average. Now, Richfield and St. Louis Park are different than Blaine and Lakeville, right? Linden Hills is different than McAllister Groveland. Actually, those two are probably fairly similar. Roseville is not Bloomington, right? Linden Hills is not St. Anthony West. Nokomis is not Marcy Holmes, and so on. So just know that YMMP, your mileage may vary, right? Your results may vary. Used to say that a lot. Actually, people don't say that anymore. Anyway, we just kind of joked about the tax credit, guys. Would anyone like to eat a pie in the sky right here, right? I mean, there you have it. So it wasn't really a real turnaround, but it was kind of this pie in the sky thing, which, interesting. The policies show up in the data, right? Policy changes show up in our data. And that's another way we can leverage this MLS data to reach out to elected officials, right? To update them on their markets, hopefully help them understand how to improve the market, add some supply, and let people be successful in getting into ownership and getting some equity. Sound good? So what was going on? Fab of 21, 100.1%. Fab of 22, 100.7. I don't think we're done. We're not done. You just said, yeah, I don't think we're done. I don't know that we'll be, so with end of 2022, my gut says this metric for all of 2022 won't be as high as it was for all of 21. That's my gut. But first quarter, right, we're 0.6 ahead, right? We're 100.7 versus 100.1. So, so far, things looking pretty strong. How about June of last year? Let's just go back to June of last year. 104.25. That was average. Some were getting 120, some were getting 90. On average, 104.2%. And that's after 2 years of maybe a little bit of softening in this metric, right? A little bit of softening. So yeah, pretty obvious what's going on there. And you guys will also note, even ahead of 04, 05 bubble levels. One more comment, you guys. Let's keep beating this dead horse for just another second. We talked about how prices and sales can be a lagging indicator. They're the thing that happens after the thing, right? This can sometimes be a leading indicator. How? Well, it speaks to how much sellers are getting, right? This depends on negotiations. This depends on inspection, wish list items, right? This all depends on a lot of things. seller pays, any other concessions, any price reductions. There's a lot of moving parts here, but check this out. This indicator peaked in 04. Our bubble didn't burst in 04. 04 was still strong. But look at this. 05 here was actually lower than 03 and 04. And then as we got into 06, lower still. So, maybe I wasn't in my role back then. Don't throw tomatoes at me. But, maybe, let me put it this way. Moving forward, I think we'll have a good opportunity to use this metric to spot changes sooner. Does that make sense? I think there's good opportunity to use this indicator to spot changes, market shifts a little bit sooner. Okay, exciting times. Inventory, we can skip this. We've got plenty of it. Joke. Okay, inventory, February inventory. How did we do? Yeah, it's tough, guys. It's tough. There isn't enough product out there. 31,500 properties listed under active status in North Star. 31,000. Now that was a little bit of our supply driven bubble. So, I don't know that we belong quite there, but I do believe we belong at 25,000, right? And sure enough, guys, okay, so a little bit of math. Let's skip ahead. Month supply. We have 0.8. It's kind of despicable, right? But let's pretend it's 1 month of supply. Let's make the math easy. 1 month of supply. What are we shooting for? 4, 5, 6. Yeah, 4 to 7, 5 to 6. Okay, so 5 months supply. If we have 1 month of supply, we have to multiply by 5 to get to 5. So to get there, we'd have to take our inventory and multiply by 5 to get to 5. So that would be about 20, about 20,000. So that would put us, right about here. Remember though, that's February, that's a winter month. Let's check this again in April, June, and July. And I bet it'll mean we'll need more like 25. So yeah, I think we belong pretty close to here. I'm not sure about here, but I'm pretty convinced we belong there.
Can I ask another question?
Yeah, thought, please.
So you just said something that sort of jogged my memory because you just said all of North Star. You mean all of North Star?
16 county metro.
Okay.
Thank you.
Because
Nope, that's my mistake.
There were some MLSs that joined us, and I'm like, if that number is including those,
They've been gobbling. North Star has been gobbling up others.
Yeah. But
Yes.
this is just the 16.
This is just great point. I really should have specified that. Yeah, thank you for doing my job better than I. This is just the 16 county metro. Hi, I'm David. I'll be talking stats for the next however. Yes, so this is great point. North Star has been gobbling up a lot of greater Minnesota boards, and I think that's a good thing overall.
I agree.
I really do. And by expanding the number of people, they can spread out the fees and costs. Hopefully that lets you guys keep a little bit more of what you work your tails off to earn. So yeah, inventory. Guys, sorry, let me back up again. So while this is a real and accurate number, let's talk about methodology, okay? It's a snapshot. What does that mean? This is a snapshot at the end of February, right? February 28th, and then if it's leap year. Last month of the year, that's when we do our snapshot, right? So we take our snapshot of all the properties listed under active status. If you're not active on the last day of the month, we don't count you as active. There's a problem there. What's the problem?
On a weekend, and
No.
or a listing activity is higher on certain days of the week.
A lot of closings are the last day of the
Yeah,
month.
that's a good point too.
That's all true. Other thoughts? No, come on.
That would even out because it would be consistent and closing days.
Kind of be some peaks and valleys that may, yeah, a little bit. Those are all good thoughts, and I think do get at what I'm trying to get at. Market times. Market times. Market times. What do I mean? If I come on Feb 10th and I'm off by Feb 20th, I'm not active. Never has that happened more. Never. Right? So are we leaving something out here? Now, okay, so 7 days. So something comes on Feb 10th and it's off Feb 17th. 7 out of 28 days it was active. Do we call that active for the whole month of Feb? It was active 25% of the time. I don't know. That's subjective. It was a listing that a buyer could write an offer on in February.
So
At a
the
time.
new listings would be more, I mean, what you're talking about is then more of like the new listings, because that's a total number of new listings in February, regardless of.
Yes, but a lot cancel, expire, and are withdrawn. and a lot go under contract too. So we're just looking at that. We're looking to get that snapshot of the actives. I mean, it's a challenge. We're right to say, oh, is it this? Oh yeah, that's an issue. You know, oh yeah. I mean, this is a challenge now. Never have more. I mean, we just saw it, you guys, right? Never have more homes been selling so quickly. So the ones that come out, you know, again, you come on Feb 3rd and you're off on Feb 7th. I can't count you as active. Yes, there was a small period of time, a small slice of the month where you were under active status, right? Do we say if you were active for more than 15, right? More than half the month, then you're inactive. If you were active for at least half the month, that's not a lot of actives that stay active for, you know, if the median is 12 or 17 days, half go off market in under 15 or 17 days. You'd have thought, yeah.
So, kind of related, but you're never in a balanced market, or if you are, you're there for a minute.
Rarely, yes.
So,
Pendulum overswings.
yes. So is there any data that you're going to be covering that tells us the number that we're at and the number that we need to be at a balanced market?
Yeah, so we sort of touched on that a little bit. So because we're at, you lead me right perfectly into the next slide that I kind of skipped to and previewed. So were we to have 1 month of supply, just to make the math easy, which we're not that far from, but last year, right, we had that 1 month. Well, we're shooting for 5 months of supply. So if we need to multiply our absorption rate by 5 to get to balanced, we got to multiply our inventory by 5 to get to balanced. And so that would be, you know, call it 5,000, that would be about 20, 25,000. So that's how many we need to be at. So to be at 25K, we'd need another 21K. So we need 20,000 active listings to get to a balanced market. Seems elusive.
That message needs to be delivered to buyers.
Yeah, that message,
They don't understand.
They don't get it.
They're just out there
they don't get it.
getting frustrated. and
Getting frustrated.
telling you, well, it's low inventory. Well, what does that mean?
What does that really mean? Yeah, what does that look like? Yeah, I think your point is so well taken. And hopefully, actually, again, you've led me into a good one here. A good way to visualize that is this. So what do we mean when we talk about a seller's market, you guys? Less than or fewer than 5 months supply of inventory, MSI. What are hallmarks here? Low supply, high demand. Sellers have an advantage, right? Robust price appreciation. Homes are selling quickly like hotcakes, right? Now look at this graphically. Here, hold 1 second. I'm going to get all 3 for you. So look at this graphically, you guys. You've got 5 buyers. They're all amped up, pre-approval letters. Maybe one has a love letter in hand, but they're all competing over 1 listing. These buyers are in fierce competition with one another. They've got to outbid one another if they want to be successful, right? That's what they have to do. Now, contrast that seller's market with a buyer's market where I've got 3 units of supply, but here I've only got 2 units of demand. What happens here? These 3 sellers have to compete with one another. Concessions, reductions, seller pays, fixes from inspection. If anybody gets those done anymore. My father. Black mold, I'll take it. I want it. Just get me out of this FOMO, please. Right. Okay. So sellers markets, buyers markets, you guys, you can kind of see what comes along with that. All the stuff you'd imagine. And then, lordy, all we're looking for is a balanced market. And again, it seems ever elusive. So you made another good point. We never really stay balanced. And let me use my mouse here so everyone can see. So look, sellers markets here, 3 months of supply. We shot right through balanced of 5 months up to a buyer's market of 7 months. Here we are, 9.5 months of supply. This is a buyer's market. That's when buyers could walk into $300,000 listings and offer 270. And you had a pretty good chance of being successful, right? 90%. Go back to our percent of original and see how far off that was. Probably not that far. So 9.5 months, and then look, 7 blew right past 5. Oh, we stopped by for one month, 1 year, right? 5, and then right back down to 3.2. So it's like you turn the oil tanker or the big Navy. Easy on the war analogies nowadays. The tanker, the big, actually easy on the oil analogies. Let's imagine you got a really big boat. You got a big tanker, you guys. You start turning the wheel. Tanker doesn't turn for a few nautical miles. It takes a little bit, right? Cruise ships. Is that? Are we cruising anymore?
I think some people.
I think some people are cruising. I heard a boomer age gentleman say, "We cruise because it's cheaper than senior housing." They have a doctor on site. They have 3 square meals a day. Their beds are made. and it's less than the 10 or 12 grand a month they throw at institutional care, and they cruise, and they get to port, they get to see stuff. Kind of blew my mind, and you can get deals if you do it, you get early enough. So I don't know, that kind of blew my mind. I mean, I'm barely 40, but I'm feeling 80, feeling 70, and maybe it's time to start. Anyway, okay. 0.8 months, guys. We are looking for 4, 5, 6, right? 4 to 7, 5 to 6 historically. So, all right, I'm not gonna spend a ton of time here. Let's do a time check. How are we doing? 1:49, there we have, okay. Okay, so I definitely won't spend a ton of time here. Guys, we've been looking at monthly data, year over year monthly data, just to look at some annual numbers. Again, I'll go pretty quick here. So new listings, guys, we've been flat for a long time. We've been up 2/10, down 1%, right, up a third, you know, so we've kind of been bouncing between 75 and 80 for a long time, right, which is problematic. I mean, it's at least good we're not down here anymore, but it's problematic because buyers are up here, right? That's why it's problematic. Buyers are up there. Speaking of buyers up there, I don't lie to you guys, buyers are up there, right? We've never seen more sales than we did last year. We've never had more closings in the metro, in the 16 county census-defined metro, Twin Cities metro. So up not quite 3% after up 8% the year prior. And here again, guys, I think buyers were running into the inventory wall. I've got my mouse here. Buyers were running into the inventory wall a little bit here, and we can't get sales because there's no inventory. One other thing, what happened in 2018? Rates. Remember, rates kind of touched 3.9 or 4.8, 4.9, I think they touched. So we saw buyers step back a little bit then. Closed sales days on market. So last year was 11, even though last month was what, 17 or something. So 11 days. So that makes my on Feb 10th and off on Feb 21 analogy pretty realistic and accurate. June of 21, what was our cumulative days on market? 7. That was a week. 7 days. A week on market. Median, half sold in less time. Pretty insane, pretty bonkers. Yes, I just said that, yep. All right, median sales price, so we ended up 11.5% to just about 340. Would have been nice to hit 340, a nice clean 340. We ended at 339.9. I like clean numbers, I'm a round numbers guy. I'm a round guy looking for round numbers. Round is a shape, I'm in shape. All right. 1019, 102% guys, average percent. So last year as a whole, sellers could look at getting 100% of their original list price plus 1.9% on top, right? About 102%. Say it again, some were getting 120%, others were getting 85%. So your mileage may vary. Okay, so just a few other thoughts, just how crazy is this market and might we be seeing some change? Okay, so the thing we just looked at was of those that are above 100%, how many were above that 100%? 80% of sales were above. The 101.9% answers the question of those that were above, how much were they above? So this tells us how many were above, but remember, some might be 100.1%. On a $300,000 listing, I'm gonna write at 302, you know, be a little safe. I'm probably gonna lose out, right? Because there's probably gonna be 330 offers. So not everybody is, you know, 5 to 10% over. So just keep that in mind. Price reductions, we've been asked about this. What's going on here? I think this is one that's very worthwhile to follow. So just looking on an annualized basis at first, all the way back to 03, guys, this paints such a clear and beautiful picture, although it's depressing at times. 50% of our deals had to have price reductions, what, between 08 and 2011, okay. That checks out. That's consistent. But what do we see since? You know, we've been floating from 25 to 27 for 3 years, and then we plummeted down to 20%, right? So we went from 1 in 4 had to have a price reduction to 1 in 5 needing a price reduction. I mean, that's not like a big change. It's a fairly significant, pretty noticeable change. All right, so that's annually. Why don't we look at this monthly, shall we? See if we can spot any interesting data points. Okay, percentage of sales with a price reduction. So this is looking at October's, only at October's. What do we notice? Still really low, but a slight tick up. Say it again, still really low, but we are registering a very slight tick up. That's October. Keep your eyeballs over here and down here. October, here we are, November. All right, October to November. Still low, but up a hair again. How about December? Still low, but up a hair again. How about January? All together now, still low. Thank you. Still low, but up just a hair. So, guys, I have a saying, once is random, twice is coincidental, but 3 or 4 times is starting to smell like a pattern, right? Starting to smell like a pattern. Once random, twice coincidental, 3 or 4 times is becoming patternistic. So whether you think this is indicative of a market shift, maybe it is, maybe it isn't. But I'm not here to tell you guys what to think or how to think. I'm here to show you the charts. Yeah, like I'll help you along, like kind of how to think through this stuff, but I'm not here to convince you. You guys got to make your own inferences from that. But we have had 4 consecutive months of increasing prevalence of price reductions, right? We have had 4 consistent months of that. But price reductions are still really low and really scarce, but higher than they were. Mach 3 to Mach 1. Still fast, but not quite as fast as last year.
Like there's a question from somebody on Zoom.
Oh yeah, let's check. We got to chat. Who we got? Well, this recording we sent over. Yes.
David, I just found it pretty interesting in those stats you just showed with 8% of homes selling for over list. That leaves obviously 20% that aren't. And not only did those, generally speaking, those 20% sell under list, they generally speaking required a price reduction. So I think when you're talking pricing with your sellers, ever important to hit the number more accurately and not shoot for the moon, because not only you're going to sell under list potentially, you might require a price reduction along with that. So it's just an interesting point that I thought.
I think it's a great point. Yeah, and I mean it does speak to strategy. Some deliberately underpriced at $299 even though it belongs at $324 or $5, and draw out some multiples. I'm not here to police. I cannot police the system, and I have no interest in doing so. But we have heard people are changing list prices up higher after. Yeah, that's an interesting one. So yeah, some of this does kind of affect and impact and inform strategy. So I think you make a great point. Okay, so monthly, guys, we won't spend a ton of time here. Just know, usually with price reductions, look, in 2019, price reductions aren't common in April and May, but they're a little bit more common in January and December. So these are year breaks. So that's 19, a U shape. Look at 21, also a U shape. Look at 2020, a W shape, right? Because price reductions were falling into September. How did we do here? Look at September. We had 1, 2, 3, 4 months of increases into September. How about here? September here. Let's go September. We had 1, 2, 3, 4 increases. In 2020, we were decreasing into September. That speaks to how spring and summer market had become fall market, right? All right, the big bucks, guys. Cash deals, cash sales. Ooh, how much cash is sloshing around our market? Not every cash deal is an investor, and not every investor uses cash, right? I think it's a decent proxy, but it's not one-to-one, not at all. So, right, it used to only be 4 to 5%, and then we already talked about these investors and flippers kind of coming in and paying cash, and then we've kind of settled out, settled into say, I don't know, 10 to 13-ish, a 10 to 13-ish range. Seems like it's more than that. Your clientele could be 50%. Other people's clientele could be 0%. So yeah, I think that really matters. Stage of life matters. Yeah, all that stuff matters for sure. Inflation, been in the news lately, including today. Anyone see what the CPI number was, the consumer price index? If it's 10%, I think the Dow is going to be down 3%. Just my gut. Anyway, okay. So nominal home prices, red, nominal. This is what we know. This is what we see. This is what buyers pay and what sellers accept. In blue, we've got implied home prices or inflation adjusted home prices in constant $2003. Oh, how I wish we could buy houses in $2003. We have to pay in 2022 dollars, inflated dollars, right? How I wish. So, right. So look at red, just look at how high red is relative to its sort of previous peak. Yes, it is well above bubble. However, once we peel back the effect of inflation in blue, we're just barely above bubble levels, right? Which tells us what? I believe that says that this market still has room to run, right? I believe that's what that means. I'm not guaranteeing that, but I think that there's a good argument to be made that because real home prices, are still not that far away from their previous peak, that tells me that the market has some room to run. There's some runway ahead of us. Do you guys remember free air at the Shell and the Speedway? Now it's like $1.50 if they even have it. Do you know why? Inflation. All right, that was terrible. I'm sorry, you guys. I'm sorry. I'm so sorry. All right, that was a bad one. I got kids now, and so I got to do the appropriate jokes. So guys, 190 grand in 03, believe it or not, would be 290K today. But instead we're at about 340. So 340 minus that 290 equals 50 grand in real inflation adjusted appreciation, which equals about 2 to 3% a year. That's what we've been saying for a century and a quarter. 2% a year after inflation. Now, it used to be 5% minus 3% to inflation equals 2% real, or it's been 5% minus 2% to inflation equals 3% real. Lately, it's 10% minus 6% to inflation equals 3 or 4% real. Okay, a few more. We're gonna skip that one. Closed sales over $1 million. I want to do this similar exercise, you guys, just what we did with price reductions. Will you permit me? Okay, so I hope that was a yes. So closed sales, August, right? August of 21, 51% for $1 million plus. Wow. August, September, okay, only now plus 5%. So still up, but not as much. How about October? Ooh, starting to see trouble in paradise. What's happening with our $1 million plus friends? Down a little bit, October. How about November? Can we confirm? No, we cannot confirm that trend. We do not have trend confirmation. How about December? Nope, we still do not have trend confirmation. Luxury market is back to growth. We do not have trend confirmation of a luxury slowdown. December, how about January? Nope, still not any confirmation of a slowdown in luxury. Nope, we don't have it. We have confirmation of rising price reductions, right? We had confirmation of that. We do not have any confirmation for $1 million plus. We had one random month that happened to where $1 million plus buyers happen to be a little bit less active, right? So I think that's a useful exercise. I hope you guys do too, to kind of look through it in that way and say, hey, we can't really confirm that this is a new trend. So overall, right, all of 21, 50%, up 50% to 1,500. That's 3 times the $1 million plus sales that we had in 05. 3 times, right? So we put up a 25% and then a 50% gain. I mean, it's pretty astounding. That's pretty astounding. Okay, we're coming up on time. A couple notes on affordability, you guys, really briefly. Don't overthink this. Higher numbers, better affordability. Lower numbers, like what we saw in 05, 06, worse affordability. I have 2 scenarios here, right? And one is at 360 grand. What did I just do? One is at 360K and 3 3/4 interest, and the other is 380K for home price and 4 1/4. And look at 380 and 4 1/4, that does get us back to sort of bubble level affordability, right? That does get us back there. I think we're a year and a half or maybe 2 from 380. So we were what, 340? So 10% would get us to 3. Yeah, maybe we crossed 370 this year. I think there's still a year and a half or 2, maybe, depending. Then again, I don't know if that price growth will be 10% this year. It'll probably be closer to 6 or 7, right? Because it's not quite as bonkers because we're Mach 1, not Mach 3. We're gonna skip those. Let's pause on this. Percentage of actives under 250. So I've got Metro in gray, Minneapolis in blue, and then our friends in St. Paul in red. I love St. Paul. I lived there for years, just off Portland and Wheeler. I love St. Paul. I just wish they didn't roll their sidewalks up at 6 p.m., at 5 p.m. We joke about St. Paul, but they've been doing a better job of hanging on to some of their affordable product. They've been doing a better job. Minneapolis, right, 30%. It's actually crept up to 37. It's crept up to 37. Metro wide, only about 23%, down from 62 and 70, right? So big changes there. where are we? We're in the beautiful city, right? So let me just make one note here. One quick note. Urban market share, the percentage of sales taking place in either Minneapolis or St. Paul. Urban market share. What was going on here, you guys? How come there's this mountaintop? How about our condo bubble, 08, 09? A lot of that was in downtowns, wasn't it, right? So that really was the spark of this back to the city movement, that urban renaissance. People wanted to be back downtown, and I believe they will again one day. I really do. But I think what will surprise people is the fact that urban market share is, well, here it was at its highest level in 6 years. Actually, is that 7? 6? Yeah, no, that's sorry, that's 6 years. So I think that'll be a surprise to most people who think there's been an urban exodus, right? I think that would surprise some people. You know, we've been reading stories. We'd actually did 2 white papers on no, there isn't flight from Minneapolis, right? It's not a thing that's happening. There is a higher degree of churn or turnover, right? So we saw seller activity increase after the summer of 2020 and all the fateful events then. But we also saw buyer activity increase substantially, right? So yes, we saw some seller turnover, but we saw buyers. I mean, for every person listing their home, there might have been 2 or 3 buyers begging to get in. So, you know, yeah, that is not the definition of an exodus or urban flights. So let's just get our heads on straight about that. All right, when in doubt, zoom out. What's going on with rates? As of a couple days ago, these guys had them at 3 3/4. A couple things I want to note. Oh, let's see if we were lying, you guys. Let's do a fact test. No, yeah, 4.9%, just about 5% in 2018. And you can see how that slowed things down just a little bit. Last time prices were this high, 06, 07, what were rates? Over 6.5%, almost 7% the last time prices were this high. Well, this is a payment business, not a price business. People look at prices and say, oh my God, they're out of control. Only 10% of people pay that price tag, right? Well, 12% pay price. Everybody else pays a monthly thing called a mortgage. Even though prices are higher than they were here, payments aren't necessarily all that much higher because of rates. That's been the offsetting blessing from above, right? If you're into that blessing from above stuff. Okay, so pretty interesting stuff. Oops, I wanted one more thought on that, guys. Just check out how markets react. Markets jerk their knees, right? My uncle said, my uncle's a pretty good investor. He said, in the short term, the stock market and the bond market is a voting machine. In the short term, it's a voting machine. In the long term, it's a scale. It kind of weighs what's good, what's reasonable here. In the short term, I'm going to yank the lever and say, I'm scared our rate's going to go up. I'm going to yank the lever because that's my vote. That's what I think will happen, or my fear. So what we see with rates is we see this knee jerk, this leg up, and then we kind of settle down. We have this big knee jerk leg up, and then we kind of settle. And you guys will notice we had this big knee jerk leg up. I don't know that we'll settle down to 3. I kind of doubt it, but I wouldn't be surprised if we hit 3.5 or 3.6, especially if we get news like a ceasefire, something, Russia-Ukraine talks, something that moves markets a little bit, that brings some calm to markets. So just something to think about. All right, last couple here, guys. We just talked about this one, but I love how they've shown it. This is from folks far smarter than I'll ever be. This is from the Harvard Joint Center on Housing Studies. So in blue, we've got median sales price, right? Median home price. This is what we pay for housing. In light blue, we've got our mortgage interest rate. So this is what interest rates are doing. And guys, don't think about the level, just think about the trend. These both started, all 3 started 1, and then we're monitoring the change from then, okay? So we're standardizing everything to 1. Mortgage interest rates, pretty much at 30-year lows. Actually, they were at 50-year lows. Home prices, 30-year highs. What's in the middle? PITI, principal, interest, tax, and insurance, at that monthly cost. And actually, and let me back up, on a national basis, not metro, not Twin Cities, this is national. On a national basis, actually, are payments really that much above bubble levels? We look at price and we talk so much about affordability challenges based on price. Is that a good exercise? I mean, it plays in somewhat, but it's not really the major factor because we have monthly payments. So we need to focus on monthly payments, not price tags on houses, right? So I think, again, this is a really powerful tool to bring to buyers who have cold feet or say, honey, are we just going to be renters forever? You know, I'm sure you guys are dealing with those people. All right, so it's three factors driving everything. COVID, the Fed, supply and demand. Yes, yes, yes. We are the lowest vaxxed country except for Russia. Yes, yes, that's great. Percentage of portfolio in forbearance, that is getting better. That is great. The chances of us having a foreclosure crisis again is roughly 0%. That's great. Nationally, what are the costs of an insufficient housing supply? It's a little over $1.5 trillion a year in lost wages and productivity. That is not great. How are we doing? Unemployment rates, large metro areas. How are we doing? So technically, I guess they have us in 5th, but we're really tied for 4th. Yeah, we're really kind of tied for 4th. I'm not sure why Milwaukee's ahead of us. Milwaukee does not belong ahead of us. All right, anyway. So how about change in non-farm employment by state? How's our jobs picture doing as of a few months ago? Pretty good, you guys, pretty good. That's why they call us the North Star state, shining our beautiful, glorious light on everything. All right, that was a little cheesy. All right, average equity gain over the last 12 months, 33 grand equity, 33K. Sounds like a lot, right? Again, I'll climb way out on the skinny branches and say 33 grand's a lot of money to anyone in this room. I'll say that's probably a lot of money to any of us. So it sounds like a lot, but really, what's our home price? 330 grand. What's 10% price growth? There's your 33 grand. Actually, prices are up 11.5%. More than that, right? It's more than that. So 33K, you know, 33K sounds like a lot. And when you really think about 10% price growth from our $340,000 price, there's your 34 grand right there. Again, I kind of hate that our Hoosier friends have somehow beat us in Indiana. Not sure how that's happened, but our friends in California and Washington, obviously bigger gains based on that percentage. The most Googled, should I question in your state? Should I delete Facebook? Should I care? Should I vote? How about our friends in Cali? Should I move out? Should I move? Kind of like that one. Should I vote? Should I buy a house? Should I go to college? Ooh, should I buy Bitcoin? That's a good one. Should I buy Bitcoin? Should I lose weight? Should I vape? Wait, there's one good one about dating. Where's the dating one? Should I text them? Ooh, should I text them?
Should I break up with my boyfriend?
You gotta wait a little while so you don't sound desperate, right? Should I text them? Should I break up? Guys, I show you this because it's funny and I like funny things, especially when we're talking numbers, but there's another reason I show you this. You can't make this stuff up. What's the most Googled question here? People care about their finances. Everybody else cares about vaping, losing weight, voting, and not caring, and texting him back, right? What is our, should I freeze my credit? This just stood out to me, and I just find it both encouraging and hilarious. The answer is yes, yeah. The answer is that is a very useful tool if the circumstances present. All right, mortgage rates. That one's shot, 30-year mortgage rate forecast. So we've got Fannie, Freddie, our friends at NAR, you know, average about 3.8, We're pretty much there. You know, I know you guys have seen this. I know you've got lenders and stuff that come in, you know, the Bell folks, you know, a lot of folks talk about this till they're blue in the face. So as rates go from 3 to 4%, how much loan can I get to keep my payment flat? Does that make sense? So if I want my payment at, yeah, of course that makes sense. You guys live and breathe this. So 12 and a quarter. Yes, of course, duh. You know, sometimes I present to like others who need a little bit more hand holding. Anyway, so right, if I want to keep my payment between 12 and a quarter and 12.50, from 3% to 3.75, I can borrow 300K versus what, 270. So that, you know, there's a difference there. There's a difference. That's worth mentioning, making sure your people know about that. Another way to see it, you know, I think this one was a little bit better, so this will be in the slides as well. And with that, my friends, I want to stop in the name of love and say thank you for bearing with me and for not leaving. And thanks to the crew on Zoom, the virtual crew. I hope this was useful, guys, even just a little bit. And thoughts or questions before we wrap up? Yeah.
So do you do any forecasting? I mean, you know, the big elements are, you know, inflation, war, and rates. So do you do any kind of extrapolating? or do
Absolutely
you-
not. Next question.
you-
I mean, we don't have a formal forecast for this year. I'll share with you guys that I would expect price growth to settle into 5 to 7, 6 to 8 instead of 10 to 12, like we've seen. I think sales will be flat, possibly down slightly. I think if we see more seller activity and inventory is there, I think sales could be flat because I think the demand's still there, even if we are at 3.8%.
Let's go.
I really think the demand is still there. What happened? What I do wrong? We need to say goodbye. Oh.
Is it fair- I usually tell them when they say our rates are rising, I mean, is that gonna suppress? And I'm like, well, yeah, it's like taking, a cup of water and pushing it on a blazing fire. Yes, it's gonna
That's one way.
put the fire out a little bit, but no, it's
A
a
little bit.
freaking blazing fire.
Yeah, what's a bucket gonna do in the scheme of
Yeah.
things? Yeah. I think it's a fair way. And the other thing, I mean, you can literally do the math. From 3.1 to 3.8 is what, 40, 50 bucks a month, 60, 70 bucks a month, 80 bucks. I mean, if 20 bucks a week is gonna make or break, you may not be ready for home ownership. You may not be ready. By the way, guys, I think maybe I shouldn't cite 2 CEOs ago. It was a couple of CEOs ago. He always used to say, tell a buyer not to buy or a seller not to sell. You've not only secured their business for life, but their referral business for life as well. Because they're convinced that you have their best interest and not yours at heart, right? Which I know you guys have. But the funny thing about today is it is not going to pay to wait. It's not gonna, right? Rates are going to be higher and prices will be higher in a year or two. That I can almost guarantee. How much higher and exactly where they'll be, I'm less confident about that. But I don't think waiting is going to pay. I have friends who think and family who think I'm going to wait 3-5 years. This bubble's going to burst and prices are going to be back at 100 grand for a house. I don't see it. I don't see it. I just don't see it. It's, in the next couple of years, is it possible prices do a -2 or 3% move? That's possible. In the next 5 years, we could see a -5%. I don't think that would be the worst thing in the world. We're so used to how quickly we are conditioned by the recent past, right? How quickly we become accustomed to all the nice things in life. There was a comedian that did on the airplane. It's like the Wi-Fi, the go-go in-flight Wi-Fi. Do people fly anymore? Nobody uses go-go. Anyway, Delta, the Wi-Fi, the Wi-Fi goes out. What do you mean the Wi-Fi went out? You guys just had go-go. You didn't have Wi-Fi 5 years ago. Give it a second. Like this is, you can access the internet while you're on a seat in the sky. Take it easy. Life is good. The internet, let's all breathe. Life is pretty good. And so, yeah, I just sometimes I need that mental reframe every now and then and to take a step back a little bit. Other thoughts? I know we're a little bit over time, guys. Other thoughts? I didn't have a chance, forgive me, I didn't have a chance to jump into InfoSparks, but if you guys will hang around for just a sec, I'd like to do a few quick ones. And I do have to jump in about 10 minutes.
Thanks, Ron. Thanks, David.
Thanks for coming. Yeah, thank you so much. Let's move our little guy there. Let's move this guy too. Well, not quite the way I want it to be, but so you know what? Here, let's do this. Let me just move. Okay, so InfoSparks, I want you guys all to know that this is a thing that you can access that's totally free and available to you. Thanks for coming. Totally free and available to you guys in North Star. Each and every one of you is paying 10 or 12 cents a month for this. Big investment. Big investment, right? So, I want you guys to use it. I really do. So you can pick any metric, right? Sales price, month supply. There's our 1.2. Let me get a little bit longer term here, guys. So there you have it, right? There's our months of supply, days on market. I'm going to click on days on market. There you have our 100 and there's our 100 days on market versus our 11 days on market, right? So I love this because it lets us split things out. It lets us divide the market. So take a look. Let's do construction type. One click. I'm going to break out the market into its individual segments, new construction and previously owned or existing units, right? I haven't done that in a while, so the data is not pre-cached, so it has to think for just a bit. Let's do a property type breakout. Our internet might not be strong enough to do any breakouts. That's okay. Just know when you play with this, you guys do click on this splitter arrow, right? That's important. When I click the splitter, I break out the market into its individual parts, its individual components. But there's something else I can do. I can also filter. So look, if I want to filter to foreclosures, I can filter to foreclosures. If I want to filter to previously owned, I can click that once and filter. But if I want to break out, let me go back to all in all. If I want to break out, I got to click the splitter arrow. So just know that there's a difference. And then one other trick I'll show you guys, price point. Not everybody knows that you can customize. Oh, please know that you can customize this. Okay, good. So and square feet, totally. You can customize that. Yes, it's amazing. We have what I'd like to call an awareness crisis. There's a crisis in awareness. People just aren't aware of what we have and of what they're paying for. All the more reason, if you guys use this stuff, you're going to have a leg up over your competition. I mean it. So, okay, we were talking about million plus. Let me just break things out so we can look at price points here. And I want to do month supply. I hope this doesn't take long. Okay, looks okay. What do we see? Well, I already see something that absolutely should flabbergast you. I'll give you a hint. That's what should amaze you. 3.8 months of supply for million plus. 3.8 months of supply. Guys, million plus is a seller's market. We've never been able to say that ever. I'm not sure ever. Our data only goes back to 03. I can say with certainty, we have not been able to say that since 03. Forgive me, guys, a little slow here, but just know that is an unbelievable. Okay, here we go. Decided to load after all. So taking a second to come in, but you guys can see the different price points. We're looking at absorption rates by the different price points. 3.8 months seller's market in million plus. That has not been the case, and that is an amazing stat. A little bit like watching paint dry and grass grow. So look, guys, million plus, 33 months of supply. 33 months of supply. Now look at when that segment healed. Once the luxury segment there healed, down to 10 or 11 months. All right, that sounded better. And then when did this all start changing? March 2020. Right, March, April, boom. Million plus suddenly had 3.8 months of supply. From 33 to 3. Holy God. Yeah, that is really quite astounding. So because of that, because absorption rates are down over 50% from a buyer's market to a seller's market, would you expect those listings to take longer to sell or less time? Come on, guys. Less time, because it's a seller's market, right? There's fewer of them and there's more buyers. So I would expect less time. Sure enough, 21 days is 70% faster. 70% faster. So look, it went from 75 days for million plus down to 3 weeks, 2.5 months to 3 weeks. It's really astounding. It's really astounding. And so let's just follow this along. One last one, you guys, because absorption rates have tightened, days on market are down, have also tightened. Would you expect sellers to be getting better or worse offers? Stronger or weaker offers? Come on, guys. Yeah, stronger offers. Yeah, you guys are smart and confident, and this is what you need to be with your sellers. 100% of original. Okay. So yeah, I think sellers used to get what, 94, 95% a million plus. They're like 98, 99 now, right? So sure, 300 to 500K is 102%, but the fact that million plus is 99% is astonishing. It is truly, truly astonishing. So don't discount the luxury segment, you guys. It's still high flying, very much so, very much high flying. So just last one here, we'll show just how low million plus was. Last one, there we go. Look at this, million plus sellers were getting 85% after the crash, heading into 11, 85%. And then for the longest time, they were getting 94 was good in million plus, 93, 94. Right. And then, we're kind of settling around at 94, 95, and then boom, up to 99, right? Like something happened. It's like a pandemic hit, right? And it did. Thoughts? Thanks for sticking around, guys. It means a lot to me. Any further closing comments, questions, email me, call me. We're here for you guys. Seriously, this is your stuff. We're here for you. It doesn't do me any good sitting in my office with this stuff. It matters that we bring it out to you and that you guys use it with buyers and sellers to help them make good decisions.
This later was at the
Yes, oh my God, and don't ever feel bad. It don't ever feel bad. So there's two ways to split things out. One, I can filter down to condos, right? Or I can filter down to townhomes by clicking on it. But let me go back to all. I'm gonna now split them out. So instead of filtering down to one, I'm splitting them all out so I can see all. So that's a little bit wonky. Some people, they're like, well, when I click on it, it doesn't split. You have to do the splitter arrow to split. So think of it like that Y, kind of from one to many. Does that make sense? Okay, yep. And then custom for square footage and prices. So you got your splitter, you've got your filter, but then you've got your actual custom little menu. So you have to actually click on the word custom. So kind of three things: custom, splitter, and then your filters. So it looks like it's just kind of one table, but there's some knobs and dials to move around there to fine tune. We don't have time to talk about all of them. I want to just mention square footage was mentioned, seller type, right? Not a lot of foreclosures or short sales now. Don't think that's going to change. 4 beds. How about waterfront? If you're in Wayzata or the Longfellow neighborhood, waterfront matters suddenly a lot, right? Waterfront matters a lot. So don't discount that stuff, you guys. And then when you're done, you click share, you choose live, share, view it in a new window, and I can now take this I can now take this URL and I can send it to whomever I want. I can Facebook it, tweet it, text it. I can get this URL. Nobody uses MySpace anymore, so don't MySpace it. But whatever. Yeah, you can pin it, LinkedIn it. Man, LinkedIn has changed a lot. Wow. Yeah. Great question. So in our interactive tool in InfoSparks here, on March 1, we showed Feb data. On April 1, we'll show March data. So it's pretty immediate in our interactive tool. However, in our static PDF reporting world with the local market updates, we have to wait a little while longer for the reports to be ran and for status changes to kind of trickle in. We've thought a lot about jumping the gun and going earlier, but we're going to miss stuff. We're going to miss status changes. So we're going to be undercounting. I'd rather be a day late and right than a day early and wrong. That's the decision that we made. I hope you guys support that. Okay, I'd rather be a day late and right than a day early and wrong. So just know, I know plenty of you do business, Golden Valley, Egan, whatever. You know that you've got that there. So yeah, here's Brooklyn Park. We were just up in Brooklyn Park. You guys will notice these are still on Jan, and we will post Feb. Actually, I think it's this Monday or Tuesday. So it's about 2 weeks into the month, and then we can kind of freeze. And remember, the vendor showing time has to get the data from Northstar. They got to freeze it and run the reports. You got to QA the reports, send them over to, so there's a process. I do wish it were faster, but there's a process, yeah. So if you really need it quick and urgently, I say go to InfoSparks. But the drawback is, okay, watch this. So closed sales. So on April 1, look at closed sales for March, and you'll see that the number increases as time goes on because those status changes are reflected. Are coming in, yeah. So it will be, you'll see this faster, but it will be incomplete. And you really need to worry more about that with what I call discrete count metrics, where we count new listings, we count pending sales, we count actives, but not derived metrics like days on market, price. Those things don't move that much. But as one is added, it adds. But as for price, when one is added, it's like, well, you still have a lot counterbalancing, right? So it's just kind of which side of the median is it on? So good thought. Other thoughts? Last one.
It's a great resource too. I like that.
Do you really like it?
Yeah.
I'm surprised to hear that.
Oh, really?
Yeah, we're not getting as much usage or traction. So we're starting to ask, is it worth throwing a couple $100 a month of member dollars at? We're starting to ask that. Sounds like you get a lot of value out of
I
it
like it.
still.
Yeah.
Okay.
Facebook periodically.
You still do?
Yeah.
Used to get like 1,200 views back in, that's 7-8 years ago. Now we're like 200, 300. So I don't know. Video, I don't know. Videos were sexy.
On your Instagram.
We do on social. Yeah, we do a little bit. We could do better.
I think it's hard to find.
It is hard to find. It's hard to find
That may
sometimes.
be part of it.
I agree. Because
Yeah.
on the website,
Yeah.
you gotta go down to the.
Yeah,
It's
market.
not easy to, it's a little bit of a search every time.
The skinny, yeah. So from our website, yeah, you got to kind of go market data, and then scroll and you'll see the skinny. And it's just that little video, that little handy 3-minute.
Yeah, I used to
4 minute.
write it. That's why.
Oh, yeah, okay, yeah, and then go to our channel or something. Yeah, so there is a link on the home site, on the homepage. You got a couple clicks. I like it. I still think it's useful and handy, especially first-time buyers that don't feel as confident looking at charts with you guys. Although today's millennial buyers are pretty data savvy and I think get it more than in past generations. But this is a more user-friendly, accessible, just friendly thing. That's just, it's high level though. It's 30,000 feet. There's not strategy here. There's not priced your home here because there's X months of supply, right? It's more here. It's just high level.
But it's also, it's not as current as I would like it.
It's a little dated.
Yeah.
The data is a little bit dated. It's true. It's true. Other thoughts? Thank you guys so much. What a treat.
Thank you.
Thank you, thank you, thank you. I always have fun doing it, believe it or not. Yeah, I like to say use the data for good and never for evil.
So 1967,
It was a good year. I wasn't around. I'm sure it was